Let me also welcome in Ridham Desai, who's also joining us this morning. Ridham, great to have you. We have been keeping track of the constant updates coming in. We know you've been on top of this, and you've also said that volatility has not yet peaked. Definitely not, particularly after what we just heard last night. Take us through your latest view on the situation, Ridham.
So, we put out a note yesterday morning, basically citing a comparison of this bear market with historical bear markets. And when I look at the metrics, I look at sentiment, I look at historical VAR, I look at the change in realized volatility, where RSI is, where valuations are, like price to book, equity to bond yield gap, everything, almost everything is hitting a new low. A lot of it is past previous bear market lows. So the metrics are telling me that we have actually hit a bear market trough. Now, of course, there are some imponderables, and as usual, every bear market is different. So the imponderables are usually different, and that's where we don't have a comparison with the past. What are the couple of things that we need to note? Actually, three things. First is that this market has not really spent enough time in around its lows. Usually, bear markets last for at least 6 months, if not more. 12 months is par for the course. This one is just 2 months old. The price decline is around 40%, which is a little shy of what other bear markets have done, which is around 50%. GFC was 60%. So we have not seen that duration. We've also not seen a peak in volatility. It seems like it's peaking because it's gone past the GFC high. But until it actually peaks, I don't think we can have complete confidence that the bear market trough is upon us. So a lot of metrics are telling us that, but these are the couple of things that are not yet satisfied. The imponderables around this particular bear market, I think, are twofold. One is, of course, very obviously, the impact of the virus and how it spreads. And to that extent, I think what we got from the Prime Minister yesterday was extremely good news, because if we are locking down this country for a period of 21 days, and going by reports from the ground, this lockdown is fairly serious. It's been implemented so far with great seriousness. I think we will be in a position to manage the virus spread, the community spread phase as it's called, pretty well. So far the numbers have been pretty well contained, and hopefully they stay that way. We'll also have to look at world data, because the virus has to be also contained in other parts of the world. And that will, I think, impact how share prices behave in the near term. The second and most important thing is policy action. Now, we've not really got much, except for some changes on regulations and reporting requirements yesterday, and a little bit of liquidity infusion from the RBI. And of utmost importance now is to actually get this policy action going, because there is a severe economic impact of this. And the more time we spend doling out that action, the greater will be the pain in the economy. So that are my thoughts, and I can hand it back to you.
That's great. You've touched upon most of the key things that we wanted to discuss with you. Just to take that a little further, and I'll come to markets in a moment. But on the policy front, you're right. We haven't heard enough. We keep hearing that it's going to be coming soon. If we do see, an aggressive fiscal stimulus plan coming in from the government, will it help to mitigate the economic impact that we're right now foreseeing for the next 6, even 9 months?
So there are three things I think that need to happen. The first is you have to protect the banking sector, because that's where the pain is the worst. You see, manufacturing companies will lose a month, 2 months, or 3 months of production. They'll be back on their feet, and they'll basically have lost 1 quarter of earnings at worst. That's not going to impede their ability to do business after that. However, financial firms, if they start facing losses on their loans very quickly, they can actually face terminal positions, because after all, they have ability only to take a 10% drawdown on loans, and then they run out of capital. So I think it's of utmost importance that the financial sector is protected. And to that extent, I think forbearance for all loans, all corporate loans, I think is important for the next 1 year at least. We should not be looking at how these NPAs are reported. So forbearance is, I think, one important step. That's actually in the RBI's domain, so not the government, but the RBI. The RBI, of course, will couple this with, say, rate cuts and with more liquidity to keep the market going. The second is, I think, the public sector banks have been infused with capital over the past several months and are also sitting on a large deposit base and a much lower credit to deposit ratio than the system. I think they need to be urged, almost instructed, to lend money to stressed sectors. So we need to see that loan growth accelerate, and in fact it should be monitored on a weekly, if not daily basis, and that number should go to say 15-20%. So we know that credit is going out, which allows businesses to support their existing cost structures. They don't need to fire people, because otherwise businesses will start losing cash, and then they will have to take extreme steps with respect to fixed cost. The third is what the government can do. And of course, we have this oil price largely sitting with us, and that may hopefully continue for a while. I think we can hike taxes there very quickly and take that money and give it to sectors that are stressed, give it to MSMEs, give it to the auto sector, give it to the airline sector, where there is direct impact from the virus. There are lots of other suggestions that are coming out, but I'll stop here because I think there's a fair bit that the government can do. I think a fiscal constraint should not be of any consideration right now, because this is in all likelihood a temporary infusion of money into the system. So we can keep aside all fiscal concerns right now and act on the economy, and then come back to worry about the fiscal later.
Nikunj also joining in. So how does one model a sector like IT, completely dependent on manpower? IT services are not essential services. The mix is anywhere between 70 to 30 on-site versus offshore. So a lot of offshore business now goes down the tube. What happens to a sector like IT, which perhaps is not prepared for a lockdown?
So, Nikunj, I am reading the government's press release, and IT and IT-enabled services have been identified as essential services. So I think you are in a position to actually start servers, and a lot of these companies are extremely sophisticated and have very good systems for work from home. So I don't see why they cannot continue functioning. Yes, productivity does drop a bit. I am working from home for the past several days, and there is some drop in productivity, but it's not zero. And I think a lot of these firms are actually well enabled. In fact, I would worry more about small and medium-sized businesses which don't have the concept of work from home and which have to interact with the customer on the ground. For IT, it was always interacting with the customer over the wire. So I don't think they are that hurt. Now, there's a separate problem, which is about how the business comes in, because their customers are located in places which are actually far more severely affected by the virus than we are, like the US, like Europe. And it's quite possible that that business may slow down. New business may not come in. And to that extent, there will be some impact on earnings and revenue. So that, I think, is certainly an issue. But the ability to execute current business, I don't think is impeded a great deal.
Ridham, so which are the pockets of the market or the economy where you think the disruption is temporary and demand will come back? And which are the pockets, companies or businesses where you think that we are in for a long winter and this disruption is going to be here to stay and they will have to readapt and remodel their businesses now?
So, I mean, Coach, that's a very hard question for me to answer. Because frankly, we don't know how people will react and how long this virus thing will linger. So as a framework, the way I think we can think about it is, firstly, how long does this continue? Because the longer it continues, the longer will be its memory. The shorter it is, the shorter will be the memory. So say, for example, just for argument purposes, we win this battle on 13th April. And on 14th April, by the actions of the government, we are business as usual, which is the expiry of 21 days. Now we have been locked down for, say, a month. I think the memory of the virus will fade very quickly. As such, we have not faced that much casualty or medical problems, and I think we'll be quickly back on our feet. Now, the opposite example is, suppose this doesn't actually get solved by the middle of April, and it actually lingers on for longer. And suppose there's a flare-up in cases, and there's a community spread. that will, I think, leave the memory imprinted with more fear, and then the recovery will take longer. So depending on what happens on that, I think we will know which businesses are affected. Now, for example, travel, will take a little while to come back. People will be hesitant in the beginning, not sure whether they should travel or not. And I think you can see that in the share prices. Actually, Nikunj, I don't think we need to think much about this. This is like, the corporate governance episode that India faced in 2009. And I remember when people called me and said, which are the companies that face corporate governance issues in India? And I said, look at the screen. All the stocks that are deeply in red are the ones that the market judges with corporate governance issue, and the market is pretty good about this. So you can see where the share price damage is the maximum. Financials lead the pack. In financials, I think it's not that the damage has already happened, but the risk that it happens is very high. And the market has singled out financials, and as such, if we mitigate this and we are done with it by middle of April, then I think you will also see the biggest bounce in financials. And then you can see the travel-related businesses, the ones that require people to move around, I think are the ones that are actually still in pain. I think usual consumer businesses should be back. There is a possibility that industrials may take a little while because it will be some time before companies actually get their act together and put capex in place. And therefore industrials may actually see some delay in orders. And maybe that won't happen now before 2021. So I think that's the way to think about it, but we can never be sure about how this will all pan out until we know when the worst moment of the virus is behind us. Even as such, the worst moment for the market may be behind us, but for the virus, it may not be.
Fair point. So, Ridham, is there a case to be made that, look, financial markets have reacted well in advance, and there is a serious case to be made that markets may actually bottom out really early and the economy may not bottom out? So, we will not get good news on the economy front, but we may start getting good news on the stock prices front.
Yes, Nikunj, that's always been the case with share prices, right? Markets tend to discount the future, and they tend to make a second guess about it, and the crowd together acts very smartly in most of these circumstances and nails it. So the share prices are going to put a bottom well before the economy. Now, when and actually where that bottom happens is always hard to tell. So the strategy has to be that prices are kind of destroyed right now. You make a second guess about what long-term cash flows are. And I think there are a lot of stocks out there that are screaming at me and saying, buy me, buy me. So that's why I'm of the view that we may be skirting with the bear market trough, just on the basis of how share prices are, rather than making a forecast on what's going to happen with the virus and the economy in the next 6 months.
Besides financials, Ridham, which are the other stocks which are screaming buy me? We'd love to know some.
See, I think financials is right on top of the list. The second would be consumer discretionary. I think discretionary consumption will come back and there will be pent-up demand. That demand is not lost. You see, demand is lost wherever there is an element of time involved. So for an airline, it's demand which is permanently lost because of expiry of time. But for discretionary consumption, it'll all come back because people still need to consume, say, autos, and they still need to do a lot of other stuff, which they have not done in the last, 1 month, and they may not do for the next 1 month or so. So I think that's the other space. I like energy. I think oil prices look like they're going to remain low for a while, and Indian energy companies actually benefit from that. So I like energy. And I think industrials is where you want to be a little bit more cautious. And actually, if you are running a portfolio and you need to fund all this, then I think I'd use technology to fund it, because I think the Indian economy will snap back if things don't get worse from here. Technology may underperform in that event. Actually, the work that I did going back in time shows that Indian EPS growth outperforms the world EPS growth in all bear markets. We tend to be far more defensive because most bear markets are actually created around global factors, whether it's GFC, whether it was the tech bubble burst in 9/11, or whether it was the Asian financial crisis. All major bear markets in India are actually brought upon us by global factors. And in those bear markets, we tend to outperform fundamentally because we actually are relatively unaffected by these things due to our inward-looking economy.
Okay, Ridham, always good to have you on the show. Take care and stay safe. That's the word coming in from Ridham Desai.